Good morning, everyone. Welcome, and thank you for joining the March edition of our On Top of Tax webinar series. For those who don't know me, I'm Karen Riley. I'm a partner in our tax assurance and risk management team, and I'm pleased to be your host for today's session. So we're going to be following our usual format today. We'll be sharing some key deadlines that you should be aware of, and then sharing a series of insights on various hot tax topics. So today I am joined by Matthew Clark, a Customs, Excise and International Trade Partner, who's going to be speaking alongside Hal Dunnett, who's an Associate Director in our transfer pricing team. And together they're going to be sharing an update on US tariff changes and the interaction between transfer pricing and customs duties and the implications that that can create. We're then going to be joined by Richard Hogg, who's a VAT partner, who's going to again be sharing a few key compliance updates and deadlines, but discussing VAT recovery calculations and adjustments and the importance of carrying out VAT training. And then finally, we've got Veronica Lipinska, an Associate Director in our Share Plans and Incentives team, who's also again going to be sharing some upcoming key deadlines before discussing tax reliefs on shares for C-suite executives. We'll then wrap up today's session with a short Q&A. So please do feel free to drop your questions in the Q&A box that you can see there at the bottom of your Zoom screen. Please do use the Q&A function though, please. That'd be really great, thanks. Rather than the chat, it's the Q&A one that we'll be looking at. But if we run out of time, please don't worry, we'll follow up with you after the event. And then to end, we'll also be guiding you on some additional upcoming BDO webinar events, which can help you stay on top of tax and to support your tax affairs. So to kick us off, I'll be giving a quick overview of some key corporate tax deadlines and sharing a very brief update on the upcoming spring forecast. So in terms of key corporation tax deadlines, so a week from today, 26th of March, Rachel Reeves is going to be presenting her spring forecast, which I'll touch on very briefly in a moment. But by the end of March, so for companies where you have March accounting reference date, March year ends, you need to file your CT returns and interest restriction returns where that's relevant to you. That needs to be done by the end of this month. Just one there not mentioned on the slide is if you're a large business within the scope of the requirement to publish a tax strategy and you have, again, a March accounting reference date, you'll need to republish your tax strategy by the end of this month. Also, if you're in the scope of the senior accounting officer regime, PLC companies with a September accounting reference date and limited companies with a June accounting reference date need to make those SAO filings by the end of this month as well. And now just briefly back to what's on the slide there. If your company pays interest, royalties or other payments falling within the CT61 withholding return requirements, CT61 filings are due to return the associated income tax at basic rate. The deadline for that in respect of any such payments during Q1 of 2025 is the 14th of April. And then touching on quarterly instalment payment deadlines, for companies within the quarterly instalment payments or QIPS regime, where you pay 2 instalments before your year end and 2 after your year end, 14th of April is a key payment date. So for example, for a 31 December year end company, the 4th instalment is due on the 14th of April. And just touching there briefly for very large QIPS regimes, your payment dates are slightly different and aren't covered on the slide here today, but again, taking a 31 December year end as an example, the first payment date would have been due a few days ago on the 14th of March. So moving on to the spring forecast. I'm only going to cover a few thoughts here on this very briefly today, as the key insights will come in future sessions and after the statement next week, but it's taking place a week today. So a recent press release acknowledged that the Chancellor remains committed to there being one major fiscal event per year to give families and businesses stability and certainty on upcoming tax and spending changes to support the government's growth mission. So based on that last part there, growth mission, we've heard that phrase repeatedly. Because of that, we expect the Chancellor's statement to focus on growth and the economy rather than taxes. So we're not expecting significant tax changes. But Rachel Reeves, I think, faces quite a tough balancing act together with a challenging economic landscape. And without further spending cuts or tax rises, the government risks missing its financial targets. So they might choose to delay corrective measures until the autumn or opt for immediate tax increase or spending cuts to stay on track. We'll see next week. But just a few potential measures there on the slide could include welfare benefit cuts. I know that that's been circulating in the press just recently. We might see extending the personal allowance freeze into 28, 29, 29, 30. And I think it's likely we could potentially see additional anti-avoidance measures and stronger HMRC powers to help raise revenues, to help reduce the tax gaps across all areas of tax. But we'll be sharing more on this via the various channels after the statement. I think beyond the spring forecast, also watch out for Tax Administration and Maintenance Day, where we are likely to see more detailed tax policy updates and consultations are expected as well. I'm going to pass over to Matt and Hal now to talk through customs and transfer pricing.
Good morning, everyone. I'd like to present to you today on, well, let's say an ever-changing issue that is affecting international trade at the moment, which is what is happening in the US with the return of President Trump and how that is affecting supply chains and customs duty and indeed transfer pricing when those imports are related party transactions. So if we move on to the next slide. Here we go. So with the return of Donald Trump to the White House to second term, it does change the international trade environment quite considerably yet again. One of the things that President Trump is doing is using international tariffs on imports into the US to affect US domestic and foreign trade policy. So he's using it as a mechanism to meet his other goals. And if everyone's been watching the news, because typically you can't get away from this at the moment, there are lots of different countries that he's focusing particular tariffs on in the first instance. Now, he has mooted, and often this is through social media, which is fairly unusual for a president, that we get tax alerts through social media rather than through a White House press release, but we have had a couple of those, that he is intending to impose tariffs of between 10 and 20% for all imports into the US. Now, he's talked about this a couple of times, but that hasn't come to fruition yet, but it does show that it could affect anyone importing into the US market. He's brought in some iron, steel, and aluminium product tariffs. So any articles of that nature that was brought in on the 12th of March will be subject to an additional 12%. Now, all the tariffs that Hal and I are talking about this morning are in addition to the normal customs duty rate. So the customs duty rate for aluminium is 10%. You add on the additional 25, which means it would then be 35% you would have to pay to land those goods into the US market. So the three big countries that President Trump has chosen to move against in the first instance is Mexico, Canada, and China. Mexico and Canada is a little bit unusual. It's caught us off guard because there is a North American USMCA free trade agreement between US, Canada, and Mexico, and yet he's still chosen to put tariffs on them. So effective the 4th of March, 25% went on the import of goods from Mexico into the US. Any goods that qualify under the USMCA agreement, that 25% won't kick in till the 4th of April. So there's kind of a month's abeyance on that. He's still discussing for the automotive industry 100% tariffs on any vehicles or merchandise produced in Mexico by US companies that have closed factories in the US and moved production through to Mexico to take advantage of the cheaper labor costs. In terms of Canada, knowing how important the energy supply is from Canada into the Northern American states, he's only put 10% on oil and gas coming in, but it's 25% on absolutely everything else. China, he has hit particularly hard. Now, these started off in February at 25 and 35. On the 4th of March, he's actually increased it by another 10%. So, for example, I've got a retail client at the moment that is paying 16% on clothing going into the US market, and because that clothing is made in China, is paying an additional 45% plus the 16%. So 61% import duty, which is playing a merry havoc with all their profit levels and indeed the profit allocations under the TP that Hal will get onto in a moment. So one of the other important things to note is any clients that use the de minimis threshold. So if you bring goods below $800 into the US, you didn't use to have them taxed. President Trump has said he will take that rule away, so that relief away, so everything will be taxed, irrelevant of the value, if it comes in from Canada, China, and Mexico. Now, at the moment, they don't have the system computing infrastructure to enable that, but they're working on it currently. So we think that could be anything from 6 to 12 months away until they can turn on the functionality to do the reporting. It's also worth noting that this is a bit of a tit for tat. So the EU has just published all of its retaliatory measures against the US for goods coming in. Canada and China have already put their list together and are putting them in place at the beginning of April. And Mexico is drawing up a list at the moment. So it's not just goods going into the US, it can be goods coming out of the US into other countries, especially into the EU. The UK at the moment is adopting a wait and see approach, Keir Starmer has said. So we are waiting to see how all these tariffs affect us. If they affect us too adversely, then we might introduce our own tariffs. But at the moment, nothing down in paper as to what the UK approach is going to be. Okay. So should we move on to the next slide? How shall I pass over to you?
Yes, no. Well, thanks, Matt. So the US tariffs, of course, are imposing massive customs duties on certain goods, as Matt has talked through. But what's crucial also is the transfer pricing. So if for goods that are imported into the US that are subject to any of these tariffs, if they are imported from a related party, that transfer price between the two related parties will be crucial in determining the value of the goods at the point they enter the US for customs purposes. So what we wanted to do is set out a little case study here to kind of articulate kind of the issue and perhaps some of the pain points that a group might be encountering. So what we have here is a high street clothing retailer. They're UK headquartered, where they have all of their design function, their key senior management, their procurement function, their sales and marketing. And they also have a US distributor, which owns and operates a warehouse as well as a customer service team. They also have a third-party Chinese manufacturer that supplies a significant amount of their goods. So crucially, as of the time that the tariffs were brought in, all goods that will be imported into the US from that Chinese supplier will be subject to the additional 35 or 45% tariffs. Now, in terms of the fact pattern, the products will physically go from China into the US for on sale. However, in terms of the actual transaction flow, the products are first sold from China to the UK at market value, and then the UK on sells to its US related party on the high seas at cost plus 40%. Now that cost plus 40% is very important, because suddenly that is the number that will be subject to the additional 45% tariffs. And so a group like this would be very interested in exploring whether and how there are ways to reduce the size of that cost plus 40% for US tariff purposes, and therefore reduce their exposure to tariffs. Now, there are a couple of things that a group should be considering here. The first is the cost, and the second is the markup. So I'll go through the 40% markup first. Here, one thing, if you take a step back, a 40% markup really is the payment to the UK for all of the UK's contributions in delivering that product into the US. So implicit within that markup is procurement services, but it might include a number of other things, such as, for example, management activities, sales and marketing, as well as certain IP, such as payment for use of the brand or payment for use of the design on the products. And not all of those elements necessarily would be subject to duty, but unless they're picked apart and separated out, the default position may be that the entirety of that 40% markup would be subject to duties. So a crucial thing for groups to consider is what of that markup applied on their goods going into the US relates to dutiable versus non-dutiable activities, and where possible, identify those non-dutiable activities and strip them out so that you are reducing the proportion of that 40% markup that is subject to the US tariffs and therefore reducing exposure. I'll just pass over to Matt to discuss how the landed costs can be handled.
Thanks very much, Hal. So I think you're absolutely right. I think it's fair to say historically, because these tariffs haven't been in place, a lot of businesses haven't needed to closely scrutinize how they're doing their import values into the US from a customs or a transfer pricing perspective. And what we're actually finding when we're working with a lot of clients is there's a lots of optimization options from a costing perspective that they haven't identified and haven't implemented, mainly because the taxes didn't really warrant it. But of course, now the cost is very much in focus because of all the additional taxes. So we're looking at all opportunities to be able to optimize it. So from a landed cost perspective, in this scenario, there is a principle when you import into the US, which is the first sale for export principle. And that means that if there is a bona fide sale from a third-party Chinese supplier to the UK business, you can actually use the first value as the import value into the US and disregard the second sale in between the UK and the US entity. Now, that in itself is quite a big project to actually put in place. It depends an awful lot about having the correct documentation, your TP agreements, purchase agreements, everything needs to be updated to reflect that position. But it is possible to do this, and we're working with some clients at the moment to actually put this in place. Now, typically, that means that, as Hal has said, only certain elements need to be added on to that price that the Chinese supplier charges the UK business. Then typically that mainly is the trademark and the IP that attaches to the goods and is intrinsic to them, and you have to add that onto it. But apart from that, most of the other things that Hal has discussed within that cost plus 40, accounting support, marketing support, various different system support, all those type of procurement support, all those things, they can be stripped out from a customs perspective. So it really does lower the price, and therefore it makes the tariff additional cost far more palatable because you're charging it on a much lower number. Now, as we've said, Hal and I are working hand in hand on this for several clients because you have to get both the customs and the transfer pricing aligned. What we're seeing in the market, particularly out of the US, is an awful lot of smaller consultancies or legal firms offering fair sale implementation services, but they're not focusing on the transfer pricing when there's a related party transaction that leads to that import. And the reason why we're both talking to you today is just to stress how important it is to make sure that both of those things align properly, both the TP and the customs duty. And one of the things as we were working through this as a conceptual problem before we actually started doing the work was about the repatriation of profit back into the UK house. So do you want to talk about that for a little bit?
Yeah, and exactly. Thanks, Matt. So a further consideration is in the US, if a profit adjustment payment is to be made back to the UK, because that payment there is a risk that unless it is properly documented, without that proper documentation, that profit adjustment payment could be regarded by the US customs authorities as attaching to the product price. And of course, what this would produce is a potentially circular outcome where you're reducing the price of the products going in, but then of course, the profit adjustment payment adds it back on to the products at the time that the adjustment payment is made, resulting in more or less the same customs exposure. Now, there are ways of managing this risk. Crucial to this is understanding the commercial drivers that are actually causing that excess profit in the US, such that the profit adjustment payment is being made. Is that due to the contributions by the US? Is it due to the contributions by the UK? Is it macroeconomic factors outside of the control of both of these parties? Or is it some third party entirely? And it is crucial to understand the drivers that create that profit, and in so doing, articulate the reasons for why a profit adjustment payment can be made, and if appropriate, why it does not relate to the products or the dutiable activities that would attach to the products. I think it's worth moving to the next slide. So what should you be doing? I'll pass to you, Matt.
I think the first thing really is to ascertain how much you're affected by this. So just identifying the supply chains that you have where you're importing goods into the US market. and then understanding what is the origin of those goods. And this is actually where a lot of businesses have made mistakes. Businesses can often look at where they purchase goods from and say, oh, that must be the origin, but it's not necessarily where the goods are originally manufactured or come from. So, for example, we do see a lot of businesses buying goods from the Netherlands, from Europe, which is a massive EU distribution hub for goods that come in from the Far East. So there could be Chinese origin, there could be Japanese and various different things, but people assume that, oh, we bought it from the Netherlands, therefore they must be Dutch origin, and they're not. So ascertaining if they are a Chinese origin is particularly important in terms of these tariffs. And what we've been doing is talking to businesses, and once they understand that there is a supply chain that's affected, we've been undertaking some modeling, haven't we? So we've looked at kind of the top 5 or 10 different SKUs of goods that they send into the US, and looking at the landed cost, looking at the profit margin within that when the sale is made in the US, and seeing how much the tariffs eat into that. And we've actually just started to do that on a reciprocal basis, anticipating the US supply of goods into the EU for one business in terms of how much they're going to be affected by the EU tariffs that they're going to be adding in April. So it can be done in both directions. And I think then what you've got to ascertain as a business is, can you live with that level of profit? So is it sustainable to sell those goods at the price that you sell them into at the moment, or does the price need to change? Can the price change? Because some people are tying themselves into contracts, so they can't immediately sell a sales price to their US customers. Or if you can change the price, how short or long term it is before you can make that change? And then the other thing is, what can you do to decrease the impact? As we said, can you optimize your valuation to lower the impact of it, to maintain a particularly good profit margin? So that's really what we're doing at the moment, just to kind of see, are you affected, identify supply chains and goods affected, calculate how much you're affected by, and then start to look at, can you live at that level of profit, or do you need to do something about it to make your position more efficient from a tax perspective? I think that's it from me, Hal.
We have one final slide, which is just a few poll questions, which I think are in the Zoom chat, which are: do you import into the US from any of the following? China, Mexico, or Canada? Do you import into the US any of the following products: iron, steel, or aluminium? And in any of the above, are they related party transactions? If the answer to any of this is yes, there is potentially an exposure to US tariffs.
We'll give it about 20 seconds, I think, to just let people answer those polls, and then I think results are popped up for us.
Just while people are voting, the thing that we would note is, as we prepared this presentation, we've updated it to make sure it's the most up-to-date US tariffs, and we've actually had to change it 7 times over the course of preparing this fact pattern. So it is a very, very fast-moving area, with the tariffs changing all the time, with the US tariffs and of course the reciprocal tariffs as well. So it's an area to stay really close to. If you do have concerns, we would recommend speaking to your customs advisors. If you have that related party transaction, you're probably worth getting transfer pricing involved as well.
Absolutely. So quite interestingly, I mean, Al, I think I knew this was coming in terms of what's the origin of the goods going into the US, because China is such a huge manufacturer of a multitude of different products across different industries. But 82% have said that they have products of Chinese origin that go into the US. And even Mexico and Canada, 24 and 18%, so still a lot of people are affected by that. Lots bringing in iron and steel and aluminium products. So again, you will be affected by those 25% tariffs. And they are, of course, non-country specific. So it doesn't matter where you source those iron, steel, and aluminium products from, or even if you manufacture them yourself, it's any products of that nature going into the US that are potentially caught. And we just need to check the particular 10-digit customs numerical code that attaches to those goods at import to see if those caught by those measures. And then if we look at there's almost a third of related party transactions in terms of the imports going into the US, and that really does warrant a very close look at your transfer pricing arrangements as well as the customs for a third of the people that have responded to that poll.
Well, thank you very much for voting and indeed for listening. I think we would end our bit of the section and pass over to the next speaker.
Thank you very much, Hal. Good morning, everybody. Nice to speak to you all. Thank you for taking the time to join us today. My name's Richard. I'm going to talk to you about a few VAT considerations which may be relevant to you at this time of year. Before I do that, though, we do have just a slide which shows you a brief reminder of some forthcoming deadlines. So as you can see there, it's mainly a reminder that you might have VAT returns due at dates imminently, as well as things like CBAM, CSOP, and plastic packaging tax returns, which are due imminently. Equally, there are more changes coming for people who move goods between Great Britain and Northern Ireland. That is a fairly constant stream of change, so I would hope people will be up to speed with that. So while these are the imminent dates coming up, I would just remind people that on the BDO website, we do have a list of upcoming dates for the forthcoming year around indirect tax changes. So if you want to look a little bit further ahead, please do visit that. It's VAT Changes 2025. If you Google that, it'll bring up our article. So what do we want to talk about today? Well, most people will be aware of when the personal tax year ends or when their financial year end is. A lot of people forget that we also have a VAT year end. What that means is it does give some businesses specific considerations around this time of year. And what we wanted to do is just spend a few minutes talking about what type of things you might need to think about if you're affected and why are they particularly important at this time. So there is such a concept as a VAT year end, which I mentioned before. Now that will either be March, April or May, depending on which VAT accounting cycle you prepare your returns on. Now, there are a number of issues that I'll cover off very briefly for you today, but the key ones focus on VAT recovery. So VAT on your costs is recoverable if it's incurred in the course of making taxable business supplies. So the obvious question arises, well, what happens if I don't make business supplies? So I do something which is a non-business activity, might be a charity, for example. Equally, what happens if I make supplies which are not taxable for VAT purposes? So I might make some VAT exempt supplies, financial services, insurance, healthcare, betting and gaming, for example. Well, if you're in those sectors, hopefully you'll be aware of the need to make apportionment calculations as you go through the year. So you can either use a previous year's percentage or you can calculate it on a quarterly basis when you file your returns. What happens though when you get to the end of the VAT year is you need to revisit those quarterly calculations, which are considered to be provisional, and effectively do a true up calculation for the full VAT year. And all that does is it irons out any seasonal variations in the different calculations that you've got. Now on screen, what you'll be able to see is how we approach both business, non-business calculations and partial exemption calculations. And as you can see for both, what we look at is directly attributable costs, and then we have non-attributable costs, which we apportion according to a calculation. So very briefly, if you've got non-business activities, there will be a calculation that you need to do first before you look at anything to do with partial exemption. You'll take directly attributable costs to your business activities. Any costs which are directly related to business activities have the potential for VAT recovery. If you have costs which are directly attributable to non-business activities, then there's no potential for VAT recovery there. And then finally, you might have some costs which you can't put in either of those buckets, and they probably get partial VAT recovery under an agreed methodology. The other apportionment calculation you might come across in practice is a partial exemption calculation. And as I say, this applies to organisations which make VAT exempt supplies. So again, you'll look for any directly attributable costs to your taxable supplies. The VAT on those should be recoverable in full. Then you'll have a look for any directly attributable costs to your VAT exempt supplies, and you won't get any VAT recovery on those, subject to some de minimis limits. And then finally, you have to apportion anything that straddles the two buckets, and you'll get partial VAT recovery on those. So as I say, throughout the year, you might use a provisional calculation. You might do the calculation every quarter, or you might use a prior year percentage. But when you get to the end of your VAT year end, March, April, or May, that's when you do the annual calculation to iron out those seasonal variations. Just as an aside, I have seen a few cases where you don't need to do this at a VAT year end, and it's for one reason or another fallen at a slightly different time because HMRC have agreed something different. So don't worry if you fall in that bucket as long as it's been agreed with HMRC. So can we just move on to the next slide, please? Thank you very much. So other things that you need to think about around partial exemption at the end of the year are if there are big adjustments between what you've recovered and what the year-end calculation says, it might be that you need to consider something called the override provisions, which might be saying that the current basis of your partial exemption calculations isn't fair. If you get those on a recurring basis, you might need to agree a special method with HMRC. So that's basically saying for partial exemption purposes, we're not going to look at income as the basis of apportionment. We're going to agree something else. And generally that requires an extensive agreement with HMRC. Equally, the end of the VAT year for partial exemption allows you to think about whether any simplifications apply and how you want to approach partial exemption in the next year. So I'm just going to jump around the slides slightly here, just to stay on the theme of partial exemption and talk about some current HMRC activity that we're seeing. So organisations which either undertake business, non-business activities or partial exemption are always of interest to HMRC because the VAT they incur will not be recoverable in full. So they generate tax yield for HMRC. A few years ago, HMRC changed their definition of what they consider to be a business activity for VAT purposes. They simplified it down to 2 tests rather than the 6 or 7 which had evolved out of case law over the years. So it is an area that we know they're looking at and we do see inquiries on our clients. With this in mind, we know they have been writing to small charities recently, just to check that they understand the need to do non-business apportionment calculations if they're affected. HMRC think that a lot of organisations in that area may be not fully aware of their requirements. Equally, on the partial exemption side of things, HMRC will periodically undertake campaigns in this area. And one of the ones we've seen recently is they've done a one-to-many campaign for private equity houses. So this is not organisations which are owned by private equity, it's actually private equity houses themselves. They've asked these organisations to think about whether they're meeting all of the VAT compliance criteria with a specific reference to partial exemption. So just very briefly then, other things that you might need to think about at the end of the VAT year. The capital goods scheme may affect partially exempt organisations. This is where you've incurred VAT on high value assets like land, property, computer equipment, aircraft, vessels, things like that. The one we see most of our clients affected by is land and property. So generally for VAT purposes, what you would do is when you incur a cost, you make a VAT recovery decision. If something falls in the capital goods scheme, you make an initial decision around VAT recovery, and then you revisit that for a period of either 5 or 10 years. So the amount of VAT recovery you can have on a capital goods scheme item can go up or down. And again, the usage is determined by reference to the VAT year. And then a final point just to mention very briefly on the end of the VAT year and why it might be important to people. If you are a large trader who's in the payments on account regime, what you will find is that your new payments on account start from the beginning of a new tax year. So HMRC will generally calculate these for you and write to you and tell you what interim payments you need to make, but they would typically start from either April, May or June. And if you know there have been significant changes in your trading pattern and you've not received that correspondence from HMRC, it's a good prompt to go back to them and ask where it's up to. I have seen a couple of organisations recently who've not received some of that correspondence and have got caught out for penalty purposes. So just a brief reminder, if you're in that, although the primary responsibility is for HMRC, just have a think about, have you had everything that you're expecting to receive from them? we just move on to the next slide, please? So with all of that in mind, some of these complex adjustments which can get forgotten about, I wanted to take a moment just to tell you about an updated VAT training offering that we have as a firm. So we have two components to this. The first is on the left-hand side of the screen there. We can do bespoke VAT training, either online or in person for your organisation, if you think you need that. The thing that's new, which we've introduced from the start of the year, is a suite of training modules. It's effectively e-learning that you can license from us if you want to train a whole load of your employees on a particular topic. That's available for you to have a look at on BDO Store. As I say, it's a year-long license. We have 4 modules at the moment, but we can develop things for people as needed. And just a final mention on the training side of things, we are looking at introducing a delegate rate training where you can effectively come to our offices and be trained on certain areas of VAT if you only have 1 or 2 people in your organisation that need support. We've done this in response to client demand. People are constantly saying to us, actually, I'm not sure how we get our VAT training up to date and we ensure that staff know everything they need to. It's particularly important these days in light of things like the guidelines for compliance for VAT, which stress that you should have appropriately trained staff. So just to briefly close off this session, then we've got a very brief poll that we're going to cover off around training. So I'd be really grateful for any insights from people about how does your organisation ensure that staff are suitably trained on tax matters? So not just VAT, but tax generally. And there's a couple of options for you on screen there. Just interested in a straw poll from our attendees today about how you manage that within your organisation. So I'll give that about 15 seconds and we'll just get some initial answers from people to see what they're thinking. Excellent. Let's see where we are with that. Well, thank you. We've had a lot of responses, so we've had 127 people reply on that, and it's a mixed bag. So very interesting that there's a big spread there of how people manage that. My only closing observation on that would be just have a little bit of a think about it if it's not front of mind. As I say, HMRC are focusing more of their efforts on how people manage their VAT compliance processes controls, and understanding that you've got the appropriately skilled staff is a really important component of that. Well, thank you very much for listening. So that closes the VAT section. I will now hand over to my colleague Veronica, who's going to cover off C-suite executives in private companies.
Great, thank you, Richard. My name is Veronica Lipinska. As Richard said, I'm a director in the Share Plans and Incentives team here at BDO, and I advise clients, private companies mainly, on anything to do with management equity, share plans, and shareholders selling their shares or passing them down to their children. Today, I'll be talking about the main tax reliefs on shares, on private company shares that affect C-suite executives in private companies. But before we do so, next slide, please. I will give you a brief reminder of the key compliance dates and deadlines that are looming quite soon, beginning of April. So we've got 4 key dates. On the 1st of April, national minimum wage increases will take effect. On the 4th of April, there is the gender pay reporting deadline, and that is a deadline for employers to report on gender pay gaps based on pay, which was as at 1st of April 2024. So looking back. 5th of April, that's a deadline for applying to payroll benefits in kind for 25-26 tax year. And of course, the one and only 6th of April, beginning of new tax year, but that's also the employer's NIC increases date. That's when employer NIC goes up to 15%, which should be quite a big deal, quite a big additional burden on employers going forward. Next slide, please. I'm aware that we've been talking at you for 40 minutes, so let's do a bit of a poll just to get everyone warmed up and to check how many people have clients who are either owner-managed business owners or C-suite executives, which are planning to transfer their shares to their children. How common is it amongst your client population? Do you have conversations to ask clients, are they looking to pass down shares? Are they looking to exit? Are they looking at share sale or trade sale? What their plans are. So you've got 4 answers. Yes, my clients are actively planning to pass down the shares to children. Yes, they're considering in the future, but not actively. No, not currently. Or I'm not sure. I'm not having those conversations with my client. I'm not sure what the future of those shares is. Give it a think. Let's have a temperature check in the room. Do you have clients who are owner-managed business owners or C-suite executives? And the answers are in. It looks like almost 60% of you replied that your clients are not currently looking to pass down the shares to children. Okay. Or you're not sure. That seems to be the overwhelming majority. Okay. So nonetheless, let's go through the main reliefs. Next slide, please. And the first relief we will talk about is the business asset disposal relief. So a whistle-stop tour in relation to that relief, which used to be called entrepreneur's relief, and a lot of people still refer to it as such. People also refer to it as BADR or BADR. It's got a lot of names. It went through a bit of a rebranding exercise not so long ago, along with some other changes. But essentially, currently, the rate of capital gains tax on disposals of private company shares stands at 24%. If an individual qualifies for business asset disposal relief rate of CGT, that lowers that CGT rate from 24% to 10%, provided that the disposal is a disposal of shares in a personal trading company. Some of you might remember this used to be a very lucrative and very generous relief. It used to apply to 10 million qualifying gains, but that limit has been brought down and currently stands at 1 million. So it's not as lucrative as it used to be, which means there is less interest in the market for C-suite individuals to claim it. And a lot of C-suite individuals have already exhausted the limit. Now, there are several requirements to be met in order to qualify for business asset disposal relief. Those requirements have also been tightened in last years. It used to be the case 12 months of holding of shares was sufficient to claim the relief. Now the period is 24 months, so 2 years. What kinds of companies' shares are covered by the relief? They need to be either a trading company or a holding company of a trading group. You can't claim business asset disposal relief when you sell shares in an investment company. That's not allowed. A person selling the shares needs to be a director or employee of the group, and there is no minimum hours requirement that is required in order to qualify. So you can be a part-time employee, or you can be a non-executive director on a minimum hours contract in order to claim that relief. The relief attaches to personal trading companies. What does personal mean in this context? Well, the individual must hold at least 5% of ordinary share capital, allowing to exercise at least 5% of voting rights. And that's why I called this presentation Tax Reliefs for C-Suite Executives, because that 5% requirement means that a lot of employee shareholders will not qualify for that relief. A lot of non-C-suite individuals, minorities, will not qualify precisely because you need to stand at above 5% of ordinary share capital. And it's not only 5% of ordinary share capital, not only 5% of voting. You need to have at least 5% of economics. So the text is fairly complex. I will not go over it. But 5% economics in broad terms means 5% entitlement to dividends and proceeds on winding up. Now, there is a relaxation to that 5% requirement in the context of EMI options. So a lot of individuals, employees, C-suite executives might be receiving their share awards in private companies through an exercise of an EMI option. We all know and love EMI options. They're the most tax advantaged options available for employees in the UK. If you hold an EMI option, you can benefit from BADR even if you don't hold 5% of equity in the business. So there's a planning opportunity there. If you want to give equity to a C-suite individual, maybe you should consider doing that through an EMI option, as then BADR might more likely apply. BADR is also subject to an extensive net of anti-avoidance legislation, such as anti-phoenixing and also transactions and securities legislation. And what that legislation essentially looks to do is to either claw back BADR on a disposal of shares, or is looking to recharacterize the whole transaction, the whole disposal, as an income transaction as opposed to capital transaction. So we always need to be mindful of anti-avoidance when we're thinking about should those tax reliefs apply. Next slide, please. Now, the benefit of BADR has been reducing substantially over the years. Less and less people can claim it. And now the rate is also not going to be as advantageous as it used to be before. As I said, the rate currently stands at 10%, but that's going to increase to 14% as of 6th of April 2025. And the rate is going to go up again to 18% from 6th of April 2026. And there are some detailed provisions in relation to unconditional contracts being entered between 30th October 2024 and 6th of April 2026 to be mindful of, which might capture a lot of people who are trying to do some smart tax planning in advance of tax rate changes. I've listed some pain points on in relation to business asset disposal relief on this slide, but I'm just really conscious of time and I will go through them really, really quickly. Obviously, if any of you have any questions, I'm happy to answer them in the Q&A box, or feel free to email me after the session. But the main pain point in relation to BADR is that it's really hard to get it if you don't have substantial shareholding in the company. As I mentioned, the 5% economics point is stopping a lot of individuals who, for example, hold shares under CSOP options or who are non-founders. The benefit of BADR is decreasing. So if we're considering that the main rate of CGT is now 24%, and if BADR goes to 18% in 2026, there is a question mark over the utility of the relief in the first place if the advantage it offers is only 6% in CGT advantage if you qualify for the relief. The relief only offers the 10% rate up to 1 million of qualifying assets, which means that a lot of C-suite executives who are serial entrepreneurs, who are serial shareholders, would have exhausted that limit already, so might not be able to benefit from it going forward anyway. BIDR can be lost in certain circumstances if individuals are retiring before they sell their shares, or if employment is terminated before the shares are sold. I've seen it quite a lot with my clients where people inadvertently lose entitlement to BADR on a transaction if they decide to step down a few days too early before they sell their shares. So if you're looking to claim the relief, some careful planning is required. But there is light at the end of the tunnel. BADR can be maximized if it's used through EMI options. So as I said before, a lot of individuals who are claiming BADR, they're doing so because they've acquired the shares as a result of exercise of EMI options. And that is still a planning opportunity for a lot of C-suite executives. Next slide, please. So the next relief I will very briefly cover today is a relief from inheritance tax, and that's a business property relief, which reduces the value of gifts by the transferor, and currently it offers a relief of 100% from inheritance tax on unlisted shares. So this is a key relief for senior shareholders, maybe individuals who are of quite advanced age and are looking to pass down the shares or the business to their children as a way of succession planning. The qualifying conditions are rather generous. A lot of unlisted shares qualify for the relief. The business must be carried on for gain and not consist wholly or mainly of prohibited activities. And there are not very many prohibited activities, you'll be happy to find out. Business cannot be sold or voluntarily wound up at the time of transfer when the relief is being claimed. There is a 2-year minimum holding requirement. So that's very similar to business asset disposal relief. You need to have held the shares for at least 2 years, and that can be grandfathered if there are spousal transfers. And the good news is the shares do not need to be UK shares in order to qualify for the relief. Next slide, please. However, there are certain changes being proposed to that relief from 6th of April 2026. We don't have a great amount of detail on those, but I will provide you with some headlines. There are planned caps to the relief, 1 million. So 100% of agricultural relief and business property relief, combined relief will be capped at 1 million. And then 50% will be able to claim on the excess. The rate of relief for shares will be reduced to 50%, a reduction from 100% to 50% in all cases. And this will not be affected by the new 1 million allowance. The new rules will apply to transfers on death and chargeable lifetime transfers on or after 6th of April 26. And it will also apply to potentially exempt transfers on or after 30th of October 2024, where the transferor dies on or after 6th of April 2026. What does that mean? In practical terms, that means that more families will pay inheritance tax on the shares and overall, given the whole inheritance tax landscape at the minute, and that more business owners might be incentivized to sell the business rather than pass it on to their children in their will. Next slide. So there are some implications and planning opportunities available as a result of those changes. Business owners can think about selling the business to an employee ownership trust. That is a very potentially lucrative alternative, as transfers to an EOT can result in 0% capital gains tax. So potentially very advantageous to business owners. However, that would mean a complete overhaul of the business ownership structure. There are planning opportunities to do with the use of EMI options, especially if C-suite executives are to benefit from value on a business exit. Care should be taken around tax relief planning, especially as part of will planning and will drafting. So we strongly recommend that if you're planning on utilizing those reliefs, you make sure the documentation, especially your will, is drafted properly to ensure tax reliefs work as intended. There are some ideas around transfers of assets to a family foundation or alternative structures. And also, I will leave you with one last idea around family businesses and making sure that each family employee holds 1 million worth of shares to maximize the reliefs. I believe that might be the end of my slides, isn't it? Back to Karen. Thank you so much for listening.
Thank you very much, Veronica. So just a super brief mention there about some upcoming tax events, which the slides will be circulated afterwards, so you'll get full details of those. 3 through the course of April and into May, tax assurance, risk management and the benefits of governance for private equity-backed businesses, our next On Top of Tax event, and our series of tax and industry forums across the different regional offices and BDOs. So details of those will be circulated within the slides after the session today. Next slide, please. Staying up to date, super quick again. We've got our monthly newsletter, and you can join our On Top of Tax LinkedIn group where you can access those regular insights and updates. And Richard mentioned there, just referring back to his session earlier, about the benefits and value of regular training in relation to VAT and our e-learning that is available. And again, the link is there in the slides to be circulated afterwards. So just a super brief Q&A. I know we had some questions coming in, so thank you very much to those who raised questions. We've also, I think we've got one quick one there on employers NI. Veronica, are you able to just very briefly cover off that one? The question is, are the employers NI increases for all employers or just some?
Yes, so changes will affect all employers, irrespective of size. So the greater burden will be spread equally. Bigger and smaller employers will be affected.
Okay, thank you very much. And there's just a couple of questions coming there around who to contact if we can't access the slides, and where people have expressed an interest in VAT reviews, etc. We will follow up with you after the event. So thank you very much for your queries there. I think we are just about to time, so I am going to wrap up the session. Thank you very much again for joining us today, and we look forward to seeing you in due course at future events. Thank you very much.